Scrum to power charting, a very special announcement before we meet up with our special guest, Professor Roman Bogomazov, to talk about the Wyckoff Method. This month, September 16th, there is going to be a fantastic day-long conference at Golden Gate University in San Francisco. The TSAASF is going to be holding our annual event. We have a tremendous list of speakers, which you can see right here. Easy to attend. Just sign up, become a member. Very inexpensive to be a member of the TSAASF nonprofit technical analysis community. And to become a member and to sign up, just go right to the website. And if you cannot attend, you will not be in the Bay Area at that time, you can live stream the conference simply by being a member of the organization. And you can watch on demand. A few days later, it will be posted on the website for members to watch. So please attend if you can, live stream if need be, and join us for this wonderful day-long event. Just to tell you a little bit more about the speakers, Professor Brett Vium, who is teaching our fall class at Golden Gate University in the technical analysis program, will be speaking. He's a tremendous speaker, great educator. Damon Povlados is going to be speaking on market profile, always interesting. I will be there talking about swing trading using the Wyckoff method. Bob Schott is going to speak on technical analysis for the buy side. And in addition, Bob will lecture on Friday, the day before. Everyone is invited to attend this event at Golden Gate University in San Francisco. Simply go to tsaasf.org to sign up for the event, completely free to attend. Should be a lot of fun. And then, of course, the iconic Linda Raschke is going to speak, and she is always a fan favorite. And then Ali Merchant, longtime technical analyst, is going to speak, a great speaker on subjects involving technical analysis. And Ian Tracy, one of my favorites, is going to talk about technical analysis and economic indicators. So please join us for this great event. We would love to see you there, and also to become a member of the TSASF. Today, we are going to talk about the Wyckoff Method, and with the idea that the Wyckoff Method is a path to trading mastery. Roman Bogomazov is one of the truly great educators of Wyckoff Method, and he has just started his teaching cycle for the fall. And I thought it was just a perfect time for us to have a discussion, and also to look at an example of the Wyckoff Method in action. Roman, thank you for being here.
Well, thank you, Bruce, and I really appreciate it here. As usual, a lot of fun to conduct those sessions with Bruce. And speaking of WTC1, we just started on Monday, so this is the first week. The first home assignment went out just to read the article, so you're totally welcome to join us as it's still so early into the semester. We're going to have 15 sessions, and if you'd like to see the first session, please go to our YouTube channel, Wyckoff Trading Method. It's a highlighted video right now at the top of all of videos. You'll easily find it. Watch the first class if you feel like you want to get together with us on the journey of Wyckoff Method exploration and studies and practice. You are absolutely welcome to do so. Bruce?
So the class, this is a 15-week semester, just as the way it was structured at Golden Gate University in the graduate program.
Yeah, I just couldn't help myself, Bruce, because I came out of academia, so what else am I going to do?
Well, you're a great educator. I mean, we worked together for many years,
Yep.
and you have actually done a lot to continue to improve the curriculum, the course, teaching method, which is, really enhanced it. And you have students that have taken this course over and over again. Is that not true?
We have the continuation of this course, which is the WTC2, the practicum course. These are more for intermediate 2 level and advanced traders, just intermediate advanced traders level. In that class, people are taking multiple times because we are talking about the sequential bias analysis there, swing analysis, VSA analysis, and that skill of visual recognition execution needs to be repeated many times because it needs to be adopted by your mind, incorporated into almost kind of like on an unconscious level, and that takes time. So you need to create habituation, and people usually take it at least 2 or 3 times as an alumni after the first time. But WTC part 1 is our kind of like a gateway, a big gateway. Before that, there is a basic charting course for those of you who are complete beginners to the technical analysis of Wyckoff methodology. This was the course that Bruce and I created, and that's the introduction on the difference and today's discussion about technical analysis and Wyckoff methodology. What is the difference, and how could they help each other, and how could you use both technical analysis tools and Wyckoff methodology in your favor? And therefore, Bruce, today's discussion, and we put just one chart, obviously one of the most important stocks, Tesla, and what we've done is we put 2 things on the chart. Well, obviously primary data that we as Wyckoffans use. And primary data is price, volume, time, and extracted sentiment from the chart about market participants. This is a big topic, so I'm just not going to go there today, but we're going to kind of think about the first 3, the price, the time, and the volume, primary data. Secondary data is all technical analysis indicators. Moving average, 200, moving average. So what does it do? It defines the directionality of the long-term structure, right? So we could look at the slope, we could see how the slope goes down, we could see how the slope starts to go up, and you could give the definition of the bias. So for instance, up to this point, everything to the downside, after this, everything to the upside. So all of your signals that are going to come from other technical indicators are going to be in the context of this 200 moving average discussion. Then you have Bollinger's wave, which is basically a measurement of volatility. You have relative strength, which we use a lot, but the correct Wyckoff term for that was the comparative analysis. And because Wyckoff did not have computers at that time, the concept of the relative strength was developed in 1950s, 1960s. He was using comparative analysis where he would put one chart under another. Then you have the OBV volume, and obviously very popular indicator, shows your buying, selling waves behind the idea of accumulation and distribution by institutional hands. And we could see that from the volume signature itself in the Wyckoff methodology. And then MACD, obviously a momentum indicator. And again, the momentum we could definitely see through the function of price and time as well. And with that, Bruce, how do you think we should approach this discussion?
Well, Richard D. Wyckoff really focused on the concept of tape reading. And he said or claimed that you could identify the present position and likely future direction of the market from the market action itself. And that, I believe, is what he meant by tape reading. And so he was entirely dependent on really price and volume. And I really wanted to ask you, Roman, do you still believe that that is the case? That you can look at price in the form of vertical bar charts and point figure charts, characterize it with volume, and be able to tell the intention of the key players in the market from that information.
I'm gonna tell you guys anecdotal story about my own trading. I started trading in 1995, 96. So it's gonna be almost 30 years now from my first trade. And my first trades were without charts. I was just looking at the quotes. And as I was looking at the quotes, I wanted to see the increase of the momentum and price advancement or decline. And that's what I was doing my first night. I was trading Forex. Lost the money on my first night, like 1500. I was like 20 years old or something close to that. And it was a big loss for me at that time, considering that I was so young. But I was not using Wyckoff methodology. I was not using TA. I was just using a TA concept of the momentum. So you could literally not use the charts to identify from the primary data the points of entry or the points of interest. Now, obviously, we don't want to do this. We want to be more informed. We want to have the charts in front of us. So then I started studying technical analysis before I stumbled upon, Hank Pruden at Golden Gate University. And my trading kind of graduated to the technical analysis where I was using a lot of indicators. And then what happened, Bruce, after that, as I was studying technical analysis for CMT examinations, I was definitely using a lot of the technical analysis tools. But with time, as my knowledge and skill in Wyckoff method has progressed, I actually started stripping away all of the technical indicators. And as of today, I'm using only four things, four primary data points: price, volume, time, and sentiment of the chart. So it took me probably, 3-5 years just to get to that point after I started using technical analysis. So the question becomes is why? Why do you strip everything, right? So to me, everything TA is kind of redundant because what is TA indicator? It's a secondary data that is derived from the primary data. So you still need to take price to create the MACD. You still need to take volume to create unbalanced volume. You still need to look at the market proxy and the underlying asset to create the relative strength ratio. You still need the price to create the moving average. You still need the price to create the Bollinger Bands. So you kind of have everything on the chart already if you don't use the technical indicators. So at some point, this redundancy becomes almost like a hindrance, Bruce. Like it's too much to look at. So I got rid of all of it, and I'm just using those four primary data points.
Right, and I'm an advocate of indicators. I started teaching graduate school by teaching all these different indicators in a survey class of technical analysis. And so I love them, but I only use them in the context of Wyckoff. And so the thing is, when you're looking at price and volume, is that you have all this richness of data, which is you have price spread, you have the extent of the spread, you can see the contraction in volatility or the expansion. You can see volume characteristics that either confirm or disconfirm price, all of these relationships and elements. And once you develop the mastery concept of the methodology of Wyckoff, then you're in a position where you can judiciously add indicators to your methodology. But in my case, when I look at Wyckoff, I look at all my charts with just the Wyckoff concepts of price and volume, and then I have a few special indicators which give me confirmation of the juncture or the point at which the market becomes actionable, either that stock, the market, whatever the instrument is. And I was going to ask you, Roman, the Wyckoff is a methodology, And so Richard D. Wyckoff, when he developed this methodology, he had a primary intention that in the creating of the methodology and what its purpose was for him and for his students, because Wyckoff was a legendary trader in his day, and this is over 100 years ago. And so what was the primary intention of Richard D. Wyckoff in this methodology?
I think just decoding the footprints of the big institutional um, market participants that are actually driving the prices up and down, because the public cannot do that. I mean, even as a herd, as a public, as a herd, the impact on the price movement is kind of like not significant. But institutions with their billions, trillions of dollars, huge positions, huge size, long time horizon as an edge to their methodology, as they rely on the business cycle rather than just like, the daily move up or down, then they are the ones that absorb the majority of the supply. And we could see this in Tesla right here around the beginning of into the end of the year and the beginning of 2023. This volume signature is telling us that this is the presence of institutions. So when you look at the effect of what they're doing, you see that they are buying aggressively on the way up. We're seeing how on the Bollinger Bands, there is some kind of contraction, suggesting that there's going to be some expansion. You could guess the directionality of the expansion behind the idea, Wyckoff idea of the accumulation by institutions, and you could have this swing trade, which indeed both Bruce and I did that. So I entered the position somewhere. I mean, we probably opened a position somewhere close. I think, Bruce, you're still holding this as a campaign. I just had a swing trade here and I was done. But you could see that I don't necessarily need to think about the expansion of momentum to the upside after the contraction, because I know from my Wyckoff studies that such aggressive accumulation will bring the rally that's going to be a better quality than, let's say, the previous rallies. So any of the rallies that we've had before. And the character of this rally is going to improve. So I know, for instance, if I'm swing trading this position right here, I'm going to swing trade with options, as this is going to be a faster duration rally and more aggressive. And that's how, Bruce, I'm kind of like building the logic towards my trade, my actual trade.
So basically you nuanced that entry point because you felt that it was the moment at which this instrument, this stock, was ready to move and move now, which was a primary objective of Richard Wyckoff, was to identify when markup was ready to begin in a really important way. And Richard D. Wyckoff was exceptional at finding the best stocks that were ready to move the most in the direction of the new primary trend of the market.
Mm-hmm.
And
yeah,
so,
three
please.
things that we identify and we teach students for us to understand at certain structural spots. The bias, so the directionality of the next move is very important. So you could use the indicators to get to the same conclusion. The timing of it, and obviously with Wyckoff, you could define the timing through the phase analysis, or you could define the timing through the presence of the supply and how supply is being absorbed or not being absorbed. And then
you teach all these concepts in WTC
sure.
1 and 2.
Mm-hmm.
Okay.
And then what we've added to the method is the intention to determine the character of the next move. So why? Again, this explanation about why would I use options here is a great example of why we're thinking about the character of the next move. Because on the more advanced level of trading, you can't just rely only on the definition of the bias. You need to have such efficiency in your trading where when you're right, you could be a pig and you could load up a little bit more and have a more meaningful position when you are winning. And that's the big mistake by advanced traders. It's not the mistake for beginners and intermediate traders because they just don't understand this concept. They are more concentrating on how to read the chart, how to, deduce the what's happening on the chart. For advanced traders, when all of that is already, very automatic, you have to think about how do I extract the majority of the money from the market, and you need to think about what's the character of, let's say, two selected candidates. Which candidate is going to go to your targets much faster and is going to bring you more money in the shortest period of time? Because ultimately, the goal of any trader, in my kind of like you, is to make maximum amount of money in the shortest period of time with the least possible risk.
And that was absolutely the thrust of Richard D. Wyckoff in his trading, and also in his the methodology that he developed and taught, I would say.
Well, Bruce, let me ask you this question. If you were to pick technical analysis indicators as a methodology versus Wyckoff method, and I think I know the answer to this, but which one would you pick if you only could pick one?
Well, I can only, Wyckoff is exceptional in the regard that it gives you context. It develops the idea of the unfolding of a market structure, which tells you when markets are ready to be range bound, when they're ready to have big up moves or down moves. And I can only think in terms of context now when I think about markets. And so indicators really don't give me context. Market structure does, and that comes through looking at price and looking at volume. And so I can add indicators to my, analysis because they help me to identify context better, but I can't do the reverse. And so to me, that's what kind of a convoluted way to answer that question. But Wyckoff, I could trade with price and volume, but I couldn't trade just purely off of indicators. Does that answer your question?
Yeah, and I think I'm the same way. I mean, the biggest point for Wyckoff methodology, I mean, like the hugest point of Wyckoff methodology above, let's say, the majority of technical indicators, which is basically a visualization of primary data, is the context, the definition of the contextual price structure, and understanding where we are in that price cycle and that price structure. The second advantage, I think, is just the idea that Wyckoff method is the system itself. So it covers the beliefs about the market. It covers the main concepts of the price cycle, of the behavioral market analysis, of the identification of the institutional footprints on the chart, and then trade management. How do we actually, after our analysis, execute the strategy? Whereas TA is just, again, I think the biggest advantage of the TA indicators is that if you don't want to spend time studying in depth how to read the chart of the primary data, price, volume, time, and sentiment, then you could just use technical analysis tools to visualize the same ideas and to use that. You might be a little bit late. You might make some mistakes. So for instance, like right here, Bruce, in this area, as Wyckoff, we already would be talking about the downtrend with the possibility of the rally that's going to fail into the lower high. So we would consider this rally to be a counter to the new trend trade. Whereas on the technical level, on the technical analysis, what do you see? You see that the relative strength is actually improving and overcoming the upsloping moving average. That's number one. We're seeing that the moving average is still upsloping as well. We're seeing that contraction, which was the correct ideal, will lead to the expansion of the next directionality. We see that there is still some buying here on the unbalanced volume, and we're seeing how the momentum is showing an opportunity for the rally. So a technical trader might be pulled into this trade thinking that there's going to be continuation beyond the resistance level. Whereas Wyckoff gives us the context that we're already in the downtrend and the rally will happen, but only as a counter trend trade. And with that, we size accordingly, we set our targets accordingly, and our stop loss strategy is going to be different. So that type of kind of like understanding through the context of where we are, what to expect, appeals to me more rather than, let's say, like just the TA visualization of the primary data.
So really the, context, so you're really describing the unfolding of distribution, which distribution is a large concept. It's a contextual concept which shows the behavior of the large composite operator interests are selling their shares and getting out of the stock. And with that, they are no longer supporting higher prices, and it produces in the long run a markdown phase. And a markdown phase can take prices down significantly. And so when you understand context, now you can put these indicators, these technical analysis indicators, and nobody does these better than stock charts. Stock charts is my go-to platform for doing my analysis. I love it. But now you have the mastery, the nuance of being able to identify the unfolding conditions that are going to lead to important markdown or important markup. And that is where really the large returns are made in trading, whether or not you're a swing trader trading for shorter term time horizons, or you're a campaign trader more akin to what I do and trade for longer term moves, which can last maybe years. So either work in the Wyckoff construct. And so anyway, I just sort of went off on that, but the idea that now you can fold in very useful tools like Bollinger Bands. Bollinger Bands are great tools, but they only make sense to me if I put them in the context of price and volume. Now I've got a context where I can identify when I think that there might be the potential for a very, very large move up, move down out of a contracting volatility phase, et cetera. And so anyway, and Roman, I know we're coming to the end, but I really want you to sort of button this up for us.
Yeah, so the technical analysis would give you 5 signals here to go along on this chart, right? So I've indicated all of them here. They are going to be associated with maybe across of the moving average on the relative strength, increasing OBV, bond balance volume, increasing momentum, and also the moving average, right? So here, someone could be easily pulled into this trade thinking that there's going to be an overcoming of the resistance. Here we're seeing how the same type of signal, look at this, look at this, look at this, but you have to make that distinction that your moving average, first of all, is not upsloping anymore, and your moving average on the relative strength is also not upsloping anymore. So how, relevant this signal is, relevant to the next rally. The same here, we can't really rely on the relative strength. The relative strength is just showing the downtrend. So here is your minus, here is your plus, here's your plus. So you have to create some kind of system based on the weight of evidence. So if, let's say, out of 5 signals here, you have like 3 pluses and 2 minuses, then this is questionable. Whereas in, Wyckoff allows us to actually go and increase the size here because we understand the context of the capitulation and we understand the context of the institutional presence and the result of it, which is the reversal and the continuation to the upside. So that is a huge difference to me in terms of the usage of the TA indicators as a methodology and as a system against the Wyckoff methodology. But again, I am extremely subjective, Bruce. I definitely love using TA tools. We have a lot of those in our arsenal, but I operate on the initial conceptual level only with Wyckoff concepts. And
Totally
that's my
agree.
story, and I'm sticking to it.
Perfect, and a great way to conclude. And please, everyone, go check out the WTC1 first class free episode, which you'll be able to see the teaching style and learn more about how the semester is going to go. And Roman is just an exceptional teacher of the method, and you are potentially on to a new mastery path for learning how to really trade at a very high level using a very exceptional trading methodology, which is over 100 years old and still proven to be very valuable. So, Roman, thank you much for your time.
Thank you, Bruce.
And we'll see you next time.
Thank you. Bye-bye.